Hi everyone, it's Christy Gray, and this is my dad, Steve Gray. He's a loan officer with Wells Fargo, and he's been in the mortgage industry for almost 30 years. This is video number 4 in our video series, Interviews with a Loan Officer. And today he's going to talk about your credit score. So what the minimum credit score required is to purchase a property and some relatively painless ways to increase your credit score.
Hi everybody. A credit score is one of the critical components of the home buying process. Why? A credit score is going to give a lender an indication of your willingness to pay past debts and how likely you are to pay their mortgage back. So ultimately, a good credit score will benefit you in two ways. Number one, more likely for the lender to say yes to you. Number two is that the pricing of the mortgage is going to be dictated by the credit score. So the better your credit is, the lower the interest rate you're going to receive and the lower the monthly payment you're going to have. So how do you know where your credit score is? If you have not looked at your credit report recently, the first step is to take a look and see what's in there. You can call a mortgage loan officer and they'll be glad to run your credit report for you, or you can go online to www.annualcreditreport.com. Be sure you spell it correctly because there are a lot of alternative sites that will pick up any misspellings and send you to their site instead. Annualcreditreport.com will give you a free credit report. You have to pay a few dollars if you'd like to see your score, but that's a good place to start. Pull your credit report, make sure that there's nothing inaccurate in the credit report. If there are inaccuracies, there are instructions on how you can dispute those items to get them out of your credit report and help to get your score improved. On the short-term basis, what can you do to manage your credit score to help to get as high a number as possible? The most important thing is to make sure that you make your payments on time. That's about 35% of your credit score is comprised of how you're doing on your monthly payments. Next most important thing is how many accounts you have and the depth of your credit. How long have you had credit? Other things that they look at are the types of credit that you have. So if you have a finance company, for example, that's going to look less favorable than a car loan or a mortgage loan on your credit report. Least important is the number of credit inquiries that you have on your credit report. People worry about that, but that's actually only 10% of your score. So 2-3 inquiries is not going to make a big difference in what your score is. If you have some debt that is delinquent, for example, credit cards where you're a month or two past due, pay those back, because once you pay those back and show that you're brought current, that usually has an immediate favorable impact on your score. An exception would be if you have collection accounts. If you have an old collection account that's on your credit report, you might not want to pay that back, because what will happen is that credit reporting agency will see that there's an updated activity on that collection account. So instead of being something that was maybe 3 years ago, it pops in as looking like a more recent thing. So talk to your loan officer before you pay off collection accounts. What's the minimum score that's required? Typically 600 is the bottom range of what you'd need to have to be able to qualify for a mortgage. 600 is considered a B. 700 credit score is considered an A. So again, the higher your credit score, the better the pricing you're going to get. This is really something that is a good idea to talk with a mortgage loan specialist before you get too far down the road to see A, where is your credit score now, and B, is there something in the short term that you can do to improve it to help you to get a better interest rate.